Welcome back to Business Daily here on Trust TV. Now, before the break, I said we're talking about the inflation report released by the NBS yesterday on our inflation numbers. Before we go there, my guest joining us virtually is Adegboyega Adebajo. He is an economist and lead advisor at AMETHYST and ASHLAR Advisory, and he's joining virtually from the commercial capital of Nigeria, Lagos State. Good morning, Mr. Adegboyega.
It's good to be online and available again this morning.
Yes, thank you so much. So, with some of our top stories, we'll look into them before we get to our conversation. I know that you at some time had a capital market, experience. So let's look at that TSEC story, the T+2 settlement story cycle. What exactly are they trying to say? If you could explain it to us in, let's say, lay terms. Is that something?
Yeah, well, one of the best things about the capital market is it's the nearest to a perfect market you could get. And it's an ideal market for raising long-term capital, something a lot of institutions really need to do. But then there is a problem if an investor wants to exit the market and the time frame within which the funds, liquidity from the market occurs. This has always been a concern. And as you know, the market itself, we will rely on platforms that have to do with financial cash transfers and all. So being able to shorten the space to no more than the day the transaction takes place and 2 more days means it's a lot more predictable to be able to obtain the liquidity from the market.
Okay.
And that's a very attractive thing to investors.
Okay. All right. Thank you so much. Although part of that story, when you go deeper into it, he's saying some countries already operate the T+1 settlement cycle. I believe that's the same day settlement cycle. That's what T+1 means.
Right. Yeah. So the thing is, the shorter the cycle, the more attractive the market itself is. If we're getting to T+2, and that's an improvement on what we had, then it tells the story that the market is getting better. Ultimately, you want to have same-day transaction. For instance, Chiamaka, if I can go back to the money markets, you may recall that there was a time, if you're sitting there in Abuja and I write you a check here in Lagos, it could take 21 days for you to realize liquidity. And that wasn't quite good for trading and for transactions between cities in Nigeria, within Nigeria. Even within the same capital, it could take about 5 working days. But today, those transfers are done in an instant. Ideally, T+2 is still lands markets have, and that's that can do instant transfers now. It shouldn't be a problem for us to be able to sort that out on the same day.
Okay, all right, thank you so much. Another story there is the IMF projections that Nigeria's GDP rate down to 36.4% in 2025 and 35% in 2026. What do you make of that?
Well, I'm one of those that, I have a big question mark on the debt to GDP ratio as an index, which a lot of countries have been using to justify their borrowings. And what it essentially says that your GDP is essentially your income, over the period of time. Now, if your debt is, say, 35% of your income, that's slightly above 1/3 of the amount of money you make, then you're fine. So what's happening in Nigeria's cases with the kind of growth projections for GDP, it simply means that there will be room, okay, to borrow some more. There's some countries like the US and a few more developed countries They've got debt to GDP ratios of over 100% already, the US in particular. But we all know what's going on there. And we know that because the dollar is a global currency, the US government continues to print money. So we need to be careful here in terms of the long-term impact of the debts we accrue. If that debt goes into productive means, then it helps the GDP. GDP grows and the debt to GDP ratio declines. Okay, because as GDP increases, that same amount of debt stock as a percentage of the GDP becomes lower. But it then tells some governments that, and when I say some governments, I don't mean any particular country, that, okay, let's borrow some more since we're earning more right now. That in itself can be dangerous because you want to look at the factors that make your GDP where, you know, the level at which it is, puts it at the level. You want to know what factors are risk elements in your GDP and can affect your income flow. All those are very important factors to consider. So it's not just about taking on debt because there is a likelihood of a decline in your debt to GDP ratio. It's about strengthening the factors that give you the income in your GDP.
Okay. Thank you so much for that insight. Now, let's get to our conversation for today. We're looking at the inflation rate. That's the story, falling to 18.02%. It's straight 6 months decline. For the past 6 months, we've been seeing a decline of our inflation numbers. We'll have a picture up for you on the screen to give you an understanding of what we're talking about when we talk about this, looking at it all the way from April, where it was 24.8%. The food inflation was 29.6%. And what were the key economic drivers? Persistent FX volatility, removal of petrol subsidy, high transport and food costs. CBN maintained market reactions. Go to May, 23.6%, 28.4% food inflation. June, headline, 22.3%, food, 26.8%. July, 21.1%, food, 24.9%. August, 20.1%. Food, 21.8%, and here we see in September, 18.02%. That's about 1.902 down, and food inflation experienced a 5% decrease from 21.8% in August to 16.87%. That's how we've been seeing that decline, both for food and headline inflation in the country in the last 6 months. However, the headline food inflation numbers are mostly put up or, you know, said it's mostly due to the seasonal harvest that we have at the moment. Now, my question to you, the first question is, you know, because one of the things we said when we were reading this story, Mr. Adebajo, is that these things came about due to a rebasing. So, how much of this inflation decline is actually structural versus statistical? We're looking at that due to the CPI rebasing.
Okay, so that's a very interesting question, Chiamaka, and it just shows that, you know, we've independently been doing some research and looking at this reason. Yeah, the rebasing or the CPI obviously has had an effect. It's a matter of a methodical change rather than an abrupt improvement in real world prices. That's the key thing. And what that has done more than anything is that, you know, it's not so much about the structural reforms. Yeah, fuel subsidies are not there. The FX market is a bit more stable. There's no tax, you know, new taxes being imposed at this time, at least not until that. You know, however, what we find is that despite these headline numbers, we're not seeing a situation where the people who interact on a daily basis economically are actually feeling the impact. Yeah, we've got the headlines dropping statistically below 20% for the first time, but for ordinary Nigerians, it actually feels much less pronounced than is reported because certain prices still feel rather volatile. But there are core drivers for this. You've been talking about the food inflation, and you know, when you think in terms of food supply, one thing I think we should bear in mind food inflation itself, the NBS looks at what happens in different states. And my research right in front of me here points out that in Ekiti State, for instance, food inflation year on year remains the highest. It's at 28.68%, and at Rivers State, 24.1%. So you've still got certain places where you have that much of an increasing rate. And let's remember that inflation is not about the price level, but about the rate of increase in prices. Okay, so prices are still going up pretty much quicker in places like Ekiti and Rivers. And the big question is, what are the structural reasons for food increases in these places? But in places like in Bauchi State, in Niger States, and those are two states that are core in terms of farming, and also in Anambra State, we've got food inflation very low in Bauchi, about 2.81%. In Niger State, about 8.38%, and in Anambra, about 8.41%. So the combination of all this, and remember, when we look to Nigeria's food inflation, we're looking at an average. And so there's always that factor about rural inflation and urban inflation. So when you ask, is this because of the rebasing? Yes, the rebasing certainly did have an effect, because it was about choosing what the basket for the consumer price index. And that would ultimately have a methodological change, bring about that methodological change about an effect.
Okay. All right. Now, we keep talking about it, and we keep saying every time food inflation always somehow affects the headline inflation every time. Now, this particular numbers that we're seeing now, could we say that this decline was due to the decline in food inflation, or are there other factors that contributed to this decline?
Well, certainly one very important aspect between beyond headline inflation, you also have core inflation. And when you look at energy prices and food prices, they come about to give that very important figure. Now, energy prices have been relatively stable. I don't imagine that the kind of crisis, and I use the word crisis advisedly, we had in the petrol sector in the last week of September, the last couple of weeks of September, with what was going on with Pengassan and Nupeng. There wasn't much of an effect, because there wasn't too much petrol out there, and the prices were still relatively stable. Now we've seen some movement in prices in energy. It's affected petrol. It will no doubt have affected diesel. It has affected cooking gas. How these will play out in the figures for October remains to be seen. And so when you ask if there are other factors that affect this, again, like I said, it all comes down to what are the components of the basket, okay, that makes up the consumer price index. The staple foods are there, and if in those areas where the staple foods are being produced, we continue to have that degree of stability, and where we're talking about things like maize, garri, beans, potatoes, onions, and all. For as long as they're coming mainly from areas where food inflation is seen to be low, it is likely that food inflation will be low, and it will moderate the effects that we may have from energy prices increasing or other prices.
Okay, so now, we're still staying with food inflation related matters. We keep talking about, how it has its impact. But now this particular numbers for this month, or for September, is set due to the harvest season. Now, let's tie it up to our disinflationary trajectory. How sustainable is this tied to seasonal harvest?
Well, okay, so once we're talking about agriculture, it could be pretty much cyclical. Again, look at the numbers I mentioned. Ekiti is high, Rivers State is still high in terms of food inflation, but Bauchi and Niger State are the west. Anambra in the east is also low. I dare say that for most of the northern part, the key or core farming areas, it's relatively low, and that's a wide gap between Ekiti at 28% and Bauchi at 2.8%. So that just tells you how what spectrum there is. In the north, you may start having a situation because of the harvest of prices being lower. But then those goods need to come from the rural areas to the urban areas. That's where transportation plays a role. That's where energy starts to play a role, and it impacts the prices before they ultimately get to the more commercial markets where they are used. Let's remember that if the harvests do not get to the markets, then the farmers are not getting the returns on their productivity and their activity for the year. So we're going to have a situation where we always must consider what goes into the CPI basket. And I say that again, when that rebasing happened in January 2025, if you recall, December 2024 was at 34.8%. That was the level of inflation.
Yes.
And when the rebasing was done in January, it came down to 24.48. That was quite a gap. And the key thing here is it just tells you the kind of impact that's had. And that's why it's a statistical disinflation, a methodological change, mainly because the nuance is that for the ordinary person on the street, they're yet to feel the impact of disinflation.
Okay, so now the Monetary Policy Committee in September reduced its rate by 50 basis points. Of course, on all that. Now, with this situation that we found ourselves now, yes, although the next meeting is in November, which is the last one for the year, are we expecting more rate costs? Do you think the CBN has what it takes to further cut the rate, or will that in any way reignite inflation again?
Well, it's a tough projection, Chiamaka, at this stage. I know that there's certain factors they're going to look at, essentially external reserves. That's been quite good. It's gone up to about 43 billion. The Naira has appreciated in its own way. There's been less of a misalignment in the disparity between the black market and the official window. Real GDP is actually growing, and I didn't just say GDP, I said real GDP. It's actually growing. It's higher than the sub-Saharan African average. And so these look like good pointers to the CBN to start to ease off, okay, on the tightening which we have experienced. I would want to see a situation where at worst we get another 50 basis points of the monetary policy rates come November. And let's all get into 2026 with hopes, of better commercial activity and returns. However, I must sound a note of warning. And ever since I came across the news story of the National Assembly thinking about pushing elections to November 2026, I've been talking to a lot of businesses about this. And the fact that from about May or June next year, now, if that comes to pass, from about May or June next year, we're going to see a lot more of politicking and much less of governance and economic management. But even if it doesn't happen in November 2026 and it's still going to happen in February or March 2027, without a doubt, by August 26, there's going to be much greater flow of funds going into politicking activities than governance or even commercial activities.
Okay, so let's stay with this just a few minutes before we go back to our conversation. During politicking times, electioneering times, campaign times, the economy seemingly does better. But if you're saying that we're going to see more funds going to political activities than commercial activities, don't they both go hand in hand?
Okay, so that's very interesting. And when you think about the fact that the economy itself is made up of different sectors, what you then want to ask is what sectors would actually prosper during politicking? And I take your point. There are those who by now would have started placing orders to import paper, to print posters and all, the usual souvenirs. Chiamaka, remember, even the price of brooms, people were stocking up brooms at a particular time because of a campaign. And so even the price of brooms will go up, something as simple as that. Yes, so some sectors would definitely prosper. But that flow going into those sectors means that some other sectors may decline. And what we find is that most countries where you have companies that trade with Nigeria, they tend to want to get the imports into Nigeria at least about 4 or 5 months before the elections occur. So if they're going to be February, March 2027, then you want your imports in by October, November 2026. And therefore you don't have any LCs exposed going into that because exchange rates, a lot can happen to the exchange. Again, like you said, two things will happen in the foreign exchange market. One, it's likely we see an improvement in Naira exchange rate because perhaps a lot more dollars, and I say that again advisedly, a lot more dollars may flow into the country. But the opposite also happens. A good number of foreign investors exit their investments to a safer place for the duration of the campaigns and elections. And those funds will only come back in after the elections and after they see some degree of political stability, then they come in. And that's the usual behavior for foreign investors. So there will be a trade-off in terms of the dollars coming in and the dollars going out. Hopefully that won't lead to an adverse effect on the Naira. And that's why exporters or importers try to make sure they transact whatever they want to transact on time before that risk becomes real.
Okay, so just answer this question for me, just briefly. Does the political spending in any way affect inflation?
Of course it does. And it certainly will when you have a situation where price is not a consideration in certain purchases. Okay. It's also, and when I say that, it means that there will be arbitrarily high prices on services that are required for the purposes of campaigns. And that may push up, the measurements. Again, people would feel if there's that much cash in the system, and this goes to the reason why the central bank itself has been trying to reduce the amount of liquidity in the system, and tying it up through the cash reserve ratios and the government issuing T-bills and federal savings bonds. By reducing the amount of cash in circulation, you're helping to stifle what would have been a factor in inflation. With the politicking and the campaigns, we expect to see a bit more cash. And you recall the last election that there was a cry that there wasn't enough cash going around the country. So we will find a lot more cash. We will find prices rising arbitrarily, and we will find that price in certain sectors will not be a consideration for purchases.
Okay, let's take a look at that graphics we had earlier again. talking about the FX part of the conversation. From what we can see, we kept on seeing from April, one of the key economic drivers for these numbers were persistent FX volatility. Then we come to May, is slight FX volatility stability. And we come to June, CBN intervention in FX. We come to July, stronger naira from FX inflows. We come to August, continuous FX improvement. We come to September, stable FX. So the FX has such a very big impact on this inflationary number. So now, what role has it actually played, this FX reunification that we had and the liquidity management in reducing this inflation?
Okay, so that's actually a key aspect of inflation management. It's so interesting that by managing your exchange rates, you're actually dealing with inflation. But that's again is because we are an import dependent country. And so the exchange rates at which we buy goods in different countries would affect the prices of goods here. And if you recall, with the subsidy being taken off and the FX market being deregulated, we had that gallop in inflation in 23 and early 2024. And it was clear for the central bank that one thing it had to do was bring about some stability to try to manage what some people would refer to as the twin evil of inflation and exchange rates. They've done fantastically well with this, with the monetary policy. The tight monetary policy simply meant that banks had to make sure that as much cash was kept back. Remember also that the previous administration had done a lot of printing funds for ways and means purposes. The central bank also had to mop all this off the markets. And so you had a situation where banks were tools for the central bank through the use of instruments to get all this money out of circulation, to fund the federal government itself, because it was there seen as federal government borrowing. And the whole idea of ways and means really it's ordinarily not a bad thing for a government to print money, but you cannot be arbitrary in the amount you print. There's a measurement to this. And what had happened previously was that that index was ignored. The central bank therefore had to bring things back in focus. So a lot of plays here. The growth and the increase in need has provided a basis to justify that amount of cash in place. Also, by reducing the liquidity in the system, the central bank made sure that there wasn't too much naira available to demand FX, whether in the parallel markets or in the official markets. And by providing an official basis to stifle demand, it has managed that. But that also tells you what would happen if naira becomes available. Let's hope the demand doesn't jump up. But most of the FX obligations inherited have been met. There are no urgent or significant demands that can affect foreign reserves or the CBN's ability to meet the demand for FX at this stage. So if that continues and it continues to be properly managed, then we will continue to see the stability we have. If that FX stability is there, perhaps inflation itself will be stable. But remember that the federal government did have a target for inflation. They were going to go to about 17% by December this year. It looks like it might be met, but then double-digit inflation is still a difficult one, because even at 17%, in 6-7 years, you're probably going to be doubling prices. So we still have a lot of work to do to bring it down to single digits.
Okay. You already preempted my question, which is how close are we to achieving the single-digit inflation? And of course, what structural changes are still needed to see that this happens? Ghana, just the last month, has been able to get themselves on single digits after, having double digits for quite a while.
Well, Nigeria is a very, very complex one. We rely so much on our exported crude for our foreign exchange earnings. The country hasn't been so diversified yet. Ghana is just getting itself into the international oil and gas market. So its agrarian industries are still there and they're still providing a certain inflow for the country. So it provides some sort of balance. But we're a bit skewed to crude oil, to the oil and gas markets. This morning, you just pointed out that for the second day, we've had a decline. The more likely there's peace in the Middle East and some stability in those regions, the more likely it is that oil prices ease. Some people consider them high at this stage at about $65 a barrel. Let's hope that it doesn't go below 60 because of projections. And what will be interesting to me will be what sort of dollar projections there are for the crude oil markets for the budget for 2026, because that's going to say a lot as to the outlook and the planning at this stage. So there are factors. We are a long way from it. I think we should still get certain things right first, then we can start thinking in terms of single digits.
Okay, all right. Thank you so much, Mr. Adegboyega Adebajo, for your insight on our conversations this morning.
Thank you, Chiamaka. It's a pleasure to be here.
And we've been discussing the recent inflation numbers, 18.02%, down from 20% over in August. That's with the September inflation numbers. We've been going down for the past 6 months, seeing a decline in our inflation numbers, and hopefully we'll keep seeing more declines and better economic, impact of these numbers in our lives. That's the much for the program this morning. I've been your host, Chiamaka Nwafor. For more of our programs, news and documentaries, do well to us on our social media platforms and on our YouTube live stream. Same time, same place tomorrow. Bye for now.